I've been awfully annoyed this week. I felt like I was purely at the end of a Weimar age receiving end LGBT orgy. I won't lie. I felt like my backside has just been getting taken by my own absolute incompetency when it pertains realistic planning. I always seem to just make some kind of buttfuck of insane notebooks that never benefits anything I'm doing, and I might be a very stupid person. Let me just show you what the fuck I'm doing. This is a lot of fuck you. It's way too much. I let's just yeah, right. So people asked me how to grab data. Now, this question confuses me a lot. It's very easy. Just go on Colab or VS Code or whatever you got. If you have never used Python before, I'd say use Colab for a minute because you don't have to install anything. You can just use it like Sheets or Docs and boom. That's data, motherfucker. Right? No, that's literally how you do it. You can make it as sexy or complicated as you want it to be. You can, if you know some Python, you can write into function and, add line chart, Kagger of stock and max drawdowns and give rewrite immediately. It's because Gemini sucks, I have to tell it that, but it's is something I have to do. Gemini is disabled and only has like no sense in its own brain. It's really fucking annoying what it does, honestly. Like, what are you doing? You're adding two cells, nigga. Please. Yeah. So you can write it into definitions here, and you get a big chart. Well, here, you can't even make no mistakes. I'm eating eggs and vibe coding a chart for you here. You don't even know how dedicated I am to this. While feeling like I'm at the receiving end of a Weimar rainbow party. Awful. Yeah, okay. Kagger. Max drawdown, right? Okay. Now, I guess that's about as much as I can take from a question like, oh, how do I grab data? Yeah, this is how you grab data, right? Because you see the data frame and it's got close, high, and da 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 da. Now, I guess it's because people are new. They don't know or have intuition for this. So let me just closely display to you why or what or how. Okay, that's why Finance, ergo Yahoo Finance. It's the easiest free API to use, whatever. And it gives you like financial data like this, but not a lot, okay? Like, it's weird. It's more like a scraper. It's not that useful. You can get this historical data up to like daily intervals. And if you want more stuff, you need to start paying. You need to start paying for things like here for intraday data on alphavantage.co, not .com. They did not have the required monetary capital to get the M, They are not Ming, they are coing. And yeah, that's really about it. Like, you upgrade an API and you look for one that fits your needs. AlphaVantage is pretty cool, right? News and sentiment, earning call transcripts for your NLP projects. Imagine catching all this with just one little deep neural network. That's pretty cool. Fundamental data, that's pretty cool because you can get like, boom, sectors and holdings and whatever. Oh, that's ETF profiles. That's actually really boring. But you can get like balance sheets, cash flow, shares outstanding. Go to alphavantage.co -documentation if you want to see stuff like that, right? And there's more. There's Polygon and these things. It's not that interesting. Now, point two, why I was annoyed. Do I have it here? I don't know. Fuck it. Well, whatever. I wanted to use like incel Excel commands, but it doesn't work, so I can't do that now. So I guess I'm just gonna start doing something else, like telling you why because some reason people still think manual technical analysis works. So that's just the next thing I'm gonna start rambling about. No, it doesn't work. Okay, I'll tell you one little thing based on the last little thing from the last video. Okay, I told you or showed you MA crossovers, right? In that little buttfuck of a notebook I showed you, right? You have ways to optimize. You have values that are objectively better than other ones that are better, right? Because they actually make sense. They're not generalizing for certain aspects of price movement that don't make sense. They are not, they're fit for something. They're built for one purpose, one asset, one profile of volatility. And that's why a gain curve just with naked trust on one particular indicator or a combination of two MAs, that's technically two indicators, looks like this, where it kind of where it linearly, incrementally, cumulatively, increasingly, progressively gains its stuff and gain in a simply defined strategy and backtest, instead of looking like, wait, this doesn't look too bad actually. Instead of looking like, I have to make it look bad now, come on. Instead of looking worse, god damn it, why did, okay, so I can just change assets, don't worry. Okay, instead of looking like this or something, or looking like, what was I using? I was using 8 and 98, right? It can look like this. This looks fucked, it's like losing money. It doesn't work, If you think that like certain assets are gonna look the same overall, you're crazy. Like, it just doesn't, okay? And the biggest example, which I find just honestly the weirdest in all of that, is the RSI. People will look for these things called divergences, right? Like where price doesn't go down when it doesn't go up or something. Like here, I guess, this is a divergence. And the only thing I can understand kind of when you're doing that is you're looking for a correction of a faulty calculation, right? I guess it's kind of made for reversals, but that doesn't compute with me, because you can't fix rules to this, meaning most people are going to kind of draw the line like this, or like this, or like this, and it's not a fixed value of 1. They're just vibing it. They're not doing anything that actually makes sense, because you're looking for a divergence. And I'm not sure if people have, kind of divergence definition. Diverging. Degree of which things diverge. It doesn't work like this, okay? I don't know. It's weird to me. I have never understood that, okay? Because everyone will be drawing their little lines like boom, boom, and here, but like every human, we have human error. If you know anything about humans and you're not like non-verbally inside, people kind of talk a lot of fucking jabroni, they talk a lot of shit. And everyone's going to be drawing these lines differently, and it's just a lot of, yeah. It doesn't make sense, okay? Guys, it doesn't fucking work. People aren't very exact. They make a lot of fucking mistakes. Just look at the government. I don't care what country you're in. They're probably making a lot of mistakes. Why? Because they're not one person talking. They're two. 20,000, probably in your local state. I don't know. And one person, that exercise where people like draw on each other's backs like they do a heart, and then the next person makes it look like kind of like a nutsack or whatever? That's what it turns into. People have something in their own head, doesn't translate right to the other person's head, and that's why coding's cool, because we can make things interpretable in one universal engine, which we then call the programming language or whatever, right? It doesn't matter what kind of buttfuck of code I insert into Python. If I want the print to be 1, I can make it is 1, right? Or like any other over-engineering way to do it, but if I want one returned, I still need it to be one. And that is not what you're getting by looking for fucking Lisa Simpson patterns, head, shoulders, knees, and toes, okay? Just so please get that stuff away from this Discord, from this channel. It does not work. Okay, now to actually start doing things instead of being a schizophrenic, I guess I'll start talking about some papers. Okay, so this is one of the first papers that I ever read about acids. It's a paper that won a prize. Now, fun fact, it actually breaks. I modeled it, it broke, okay? Because it uses a bunch of ETFs. But there's a bunch of stories and things that I would like to tell you about this, right? Because I think that it's written in a nice way where you can learn a lot from it. For example, the abstract. Passive management over the last years has attracted greater attention than active management. Bloomberg reports that only in the first half of 2017, flows of active into passive funds reached nearly 500 billion compared to the 300 billion dollars in 2016. This migration, encouraged by the spread of ETFs, concerns not only retail investors but also institutions and financial advisors, yada 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 yada. This demonstrates how allocation of a portfolio designed for passive management can represent the foundation of an actively managed portfolio through a non-discretionary quantitative strategy that can outperform the market. Now, the whole point of my channel or Discord or Instagram page is to be non-discretionary, because unlike these douche nozzles drawing the Bart Simpson patterns and the cock and ball patterns and these things, you can define things on rules. And this paper does tell you a very easy way to do it with a lot of logic, which is what I love. Things that make sense. It also tells a little bit of a story about how passive management is very popular, but how you can use an active management way to kind of do the same, okay? It tells you a little bit of a story about ETFs and efficient market hypothesis. It sums a lot of things up, right? What is efficient market hypothesis? The theory that information is available to all market participants. No, no, most people don't read it, or are you know, drawing. They're drawing the cock and balls pattern, you know. So no, there's a lot of people fucking up, so they're semi-efficient, okay? But that's different. People tend to subscribe to this. Market participants act on this information. They might be acting upon solar winds, astrology. Yeah, I swear to God, this exists. Like, what the fuck is this? Moon longitude. Oh, too many indicators. Fuck. I really needed that fucking Saturn one. Astrology. This exists, dude. They don't work. No shit. That's got double definitions. Alright, market... No, that's also not true. Okay, I've debunked the paper even harder. No, but it tells you what efficient market hypothesis is. You know, these are the assumptions made, right? This is more like on the higher level, and of course you're gonna get eaten by sharks and these things. I just like to fuck around and make fun of things. But this one, it's one of the founding fathers of finance, you know? ETFs can be seen as some of the most successful financial innovations. Now, of course, like day traders, there are a shit ton of people that fucking love the fuck out of exchange traded funds because the market goes up a lot, and then if you just... This is one of the craziest biases I've ever heard, by the way. Like, oh, the market goes up a lot. Yes, it does. Inflation, price increasing, you know, yes, the market in general goes up. So if I literally buy every stock, will that happen too? Yes. If you buy everything in the world, will your portfolio increase? Yes, by like 10 or 12%, depending on how shitty the decade is that you live in. But you just won't really make a lot, and you'll be 65 by the end of it. So fuck that. That's kind of a stupid theory, honestly. Also, having to sit through something like the dot-com bubble over here, I'm doing my own Bart and Lisa Simpson patterns, but if you have to sit through the resets like 2008 and these things, and you know, that's emotional torture. That's why I was talking about moving averages a lot in the last video. Like, it doesn't compute in anyone's brain. Like, if you are the type of person that can sit through a dot-com bubble and buy and hold, and you're just buying, like in dollar cost averaging every time, my guy, please become a Navy SEAL. I can't do it. You have balls of steel. I can bench 3 plates, but I'm sure you can bench about 8 and fuck my bitch. No, I can't do it. Whatever. ETFs became popular because they're easy, okay? That's why. There's this whole moniker, you know, and I'm sure you've heard them. Warren Buffett wants you to buy everything because blah, blah, blah. But that's mostly because it's easy and it's hard to fuck up, okay? Unlike day trading or whatever, which is really easy to fuck up, holding the S&P is really hard to fuck up. So this is easy to fuck up, this is hard to fuck up. That's why they're huge beliefs. And then you have maybe the fuck baby of both, which is algo trading or non-discretionary methods, which is arguably hard because you have to program and use logic. Which, if you look at the current political climate, is impossible for everyone. Haha, do not add me into Discord, please. No more politics. Okay, so ETFs are popular because Warren Buffett talked about it a lot, because you have to diversify a lot, because that's, you know, the methods given to you by like Benjamin Graham or something. Okay, fucking cool. But you get exposed to low gains, like very low returns, and still a lot of risk. That's why I was coming at y'all with those moving averages, you know? Like, they actually reduce risk a lot. Right? Like, if you go on the daily, I showed you that, boom, 13%. That is nothing, sir. That is very little. Even the generalization is pretty alright. You know, 60 on Bitcoin, not too bad. The Dow Jones, it gets fucked. But I haven't built an algo that works on the Dow Jones, and why would I want to? It makes no sense again. Blah, 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 blah. Right? So the paper builds on a lot of these principles. And I would really recommend reading it much more slowly and not be frantically not ranting about it a lot like I am. But these are a lot of my pet peeves. These are things that I kind of want to scream at people so that when I continue making videos, I can stop talking about it. Okay, so something cool we can actually do. What actually makes sense about day trading is studies on breakout range and trend concept models. I've already talked about trend following and stuff. I haven't actually mentioned breakouts and whatever. Breakouts are actually pretty legit. Though for this example, my god. Okay, fuck you. Okay, so for this one I'm actually gonna draw on the chart, right? Because there's actually a merit in drawing this time. Drawing on the chart, by the way, which day traders fucking love, has one merit, and that's describing what happened, not what's going to happen. Thank you. It something like this. Yes, this is a channel, but here we have a breakout. Here we have a breakout. Here we have a breakout. Now traders think they can somehow draw lines. No, you have things like an ATR, which is an objective metric of these things happening, right? You have changes in this number which observe some of these ranges, which kind of show you when the channel of the price changed, right? And that's something kind of cool. You have those ranges, which are these channels that I'm telling you here, and then you have the breakouts out of them, which are things people trade off. You can also model in an algorithmic model, and some of it comes together in this paper, right? So it's measuring absolute momentum, which is close today, close n days ago, close n days ago. This is the formula I wanted to explain to you. This. Oh, it's even simpler. Wow. Yes. So that's momentum. Momentum is stupid easy. Fuck off. Why do I have to open twice? Okay, so momentum measures like the general percentage change of the price changing and stuff. And that's cool or whatever. So they rank it. Then they have volatility, which is the variance of standard, it's squared standard deviation. So It's the risk measure. You know, you should know this. Volatility in finance. It's standard deviation. Boom. The range of like 64 or 68% of price. Read this, pause it. I don't even want to explain. They rank it. Okay? Average correlation. Now that's the basic theory of portfolio construction and optimizing, right? One goes up, one goes down. We are breaking even. Won't explain either. Go Google that one. ATR breakout system, which are the breakout ranges that I just told you about, and they modeled it. Aha, fucking genius. So here you see them setting up buying rules, right? They're defining the rules of buying. It's not like I'm drawing line, I'm trying to fucking find a needle in haystack of a pattern. They're defining fixed rules that actually make sense and have logic and stuff, right? And then they take certain assets and they use a backtest. That's what the non-discretionary method is starting to form here. And here they describe the certain channels, ATR breakout, having defined instruments for volatility of an asset. They try to give it, here you can see it changing as it really drastically changes, movement. These are those channels. Here you can see a big movement, here you can see a big movement, yada yada yada. Now, ranking model, blah blah blah, not too interesting. Here you can see the different assets. They are changing according to those rankings, yada yada yada. You see the list changing here. Actually, yeah, of course, this is the individual rankings. And then here you can see kind of the formula, right? So they have the ranking of momentum, volatility, correlation, and then they have a value assigned according to those rankings, and then a weight. So they probably splitted that evenly, and they ranked from 1 to 11. So then they get to the tests, right? So you gotta imagine that in every month in this paper, so month 1, 2, 3, they had a ranking from 1 till 11, and then of course stock Vanguard was this, stock medium cap was this, stock small cap was number 3, and then maybe in this next month the next one went to 1, this one went to 2, yada yada yada. Okay. Now I want to show you the results. If you want this paper more in depth, you first of all should not be listening to a fucking schizophrenic who feels like he has been at Berghain all week, but he was in VS Code instead. You should read it. It's easy to read. It's only 24 pages. I think if you read into it a lot, it's going to be very good for you. I'm just giving you a fucking schizophrenic's introduction, okay? Yada yada yada. You look at this chart, it becomes very interesting. You can see that in 2008 it lost very little money. This is the same thing that I showed you last time, right? And that I was ranting about before. If you're using simple technical indicators, you can actually prevent a lot of these losses because they have defined exit rules. And you're also not totally vibing it with Bart Simpson head, shoulders, knees, and toes patterns. You have rules and they make sense because they're built upon a methodology. And that's why I'm trying to fight all the discretionary methods in the market, and I'm an ideologue and I'm gonna indoctrinate everyone. No, we don't. We do not do this. Okay, so it's getting very good returns here. You can see in this little table that it also didn't lose money in 2008. If you align this, you can see the month-to-month gains. You can see it's very solid and it annualizes at about 16.9. It tested from 2004 to 2018. So you can see it's very solid, right? And it's rotating through all those things. I believe the Sharpe ratio is, it's 2, which is also really good. Don't get this, a little bit too optimistic about results like that though, because to be fair, these are ETFs. And when I tested this one, when I modeled it like years ago, it actually breaks. That doesn't disprove, by the way, or discount any of the conclusions made in this paper. Because it is very solid methodology. I think it introduces a lot of good topics, like when you actually start reading into it a little bit more. I'm not gonna like read you to sleep. I don't want this to be an hour-long video, even though I'm probably already getting up there quite formidably. But also because I'm trying to keep this at least somewhat fun to watch while still giving some information. But it does break, but I improved it. You know, I replaced the stocks. I will be filming that as well. I will be trying to make like some kind of factor model along those lines. Yada yada yada. I improved it. I'm gonna try to film that. I have ways to improve it in better ways. But this is just one little paper that I wanted to leave you with. Look for it, tanassociation.org, WP content, blah 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 blah. I guess I'll just leave this in the description. It's really cool. I'll read the description with you. In this paper, I found that the creation of indicators useful to measure components such as momentum, volatility, correlation, and trend. These indicators have been applied to an automatic asset allocation model, ranked asset allocation model, RAM, able to rank assets and calculate their weighings within the portfolio according to market conditions. The non-discretionary quantitative model was applied to a strategy originally designed for a passive portfolio, the 712. We have shown how the combination of two seemingly irreconcilable strategies, passive and active, have led to the creation of a model capable of outperforming the benchmarks and the market in a constant way. The signals and results have been confirmed by all evaluation methods and seem solid to avoid any chance. Now, why does this really work? I'm going to just make that really fast. Market tends to go up, so they measure when market go up, right? In these phases. Then when breakouts happen, the switching of the channel, they exit, right? They exit the market. Then when market goes back up, they enter again. There are some easy measures they use to do this, to kind of time the market very softly. Why does it work? Because price movement and everything in that sense, if you optimize them a little bit and you smooth out the intervals, which means if you're not on like a noisy time frame like this, it's actually fairly predictable. Daily intervals are very smoothed out. You don't have to deal with multiple bars and candles being like lunch hour or not the market opening. No, one bar contains a lot more fucking information. Okay, that's why it's actually possible to use those moving averages or use those ATR channel breakouts to see where the shifts really lie, right? Like as you could see here, right? The shifts that they were taking with these ATR channels switching are actually quite significant. You can really see that the volatility channels of the average true range, which is a volatility measure by the way, blah 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 blah, you can see it that they time it quite consistently. So in a way you can see that this paper really borrows on the same methodology as to why passive investment works, but they just apply a little bit of spice from active management. They use a few buying rules and they really prevent something crazy like these drawdowns that you see in all these big major market correction and black swan events like 2008. And that's something that really hit me in the beginning as I was messing around with these papers, where I'm like, wait, why do people voluntarily sit through this emotional torture? It doesn't make sense, because this paper truly is not that hard. This is quite simple. If you go into the reference list, like imagine you read this and you find it interesting, right? Read some of the other papers, right? So you can try this one. This one's really cool. You can read into this one. It's really cool. This one's basically the same paper, just way deeper. So definitely Google that. You can start reading into more indicators with technical analysis explained. You can try to read into technical trend trading systems here. Those are some of the little ones that I can recommend you, but definitely Hallmark, big paper, I would say, for introduction and for more people still in the orientation side of things, like people who haven't figured out how to pull data or whatever. This is also something I want to give with you as I'm eating my eggs and they're getting fucking cold right now. Goodbye.